Coachella Valley, and welcome to Live with Your Chamber. I'm your host, Katie Stice, CEO at the Rancho Mirage Chamber of Commerce. And really, the presentation today is very timely. We're going to have an economic update with your good friend out in the community, Charles Alfaro of Raymond James. How are you today, Charles?
Hey, Katie. Thanks for having me.
Absolutely. So what do we have in store today?
First off, I want to thank you, right? You're, throughout the whole virus and lockdowns, the work you've done to keep the members and the community informed has just been remarkable. So I want to thank you for that. And I think it's been nearly a year since I've given an economic update, and we're back in lockdown during that time. And it's interesting that although it's already August, we're still facing some of the same issues, and we're also facing new issues, right? Like,
right.
Uncertainty with inflation. There's supply shortages across the board in different parts of the world in the country. So this time around, I thought it'd be great to have some of the brightest minds, I believe, from our firm to share an economic update, along with some Q&A as well. So we have Jake Fleischer, who is Vice President, Senior Asset Management Consultant, and Nick Lacey, who is our Chief Portfolio Strategist for our Asset Management Services team. So gentlemen, thank you so much for being here today. Jake, feel free to take it away.
Thanks a lot, Charles. And first off, thank you all very much for joining. As Charles mentioned, my name's Jake Fleischer. I've been with Raymond James Financial for 5 years now, originally from the southern part of the United Kingdom, a town called Bournemouth. And since I joined Raymond James 5 years ago, I've always been in the asset management department. Raymond James is headquartered in St. Petersburg, Florida. We have roughly 5,000 full-time employees there. And in our department in asset management, the department that Nick Lacey and I work in, we have roughly about 450 full-time employees. And we really focus on two main things for the firm. Number one is asset allocation, meaning what areas of the market do we feel comfortable owning today and the reasons why. And then two is due diligence. We spend a lot of time, money, and resources going out there and finding the best money managers that we can recommend to our Raymond James financial advisors. And think of my position. I'm a senior asset management consultant. I work for Charles. I'm an extension of his team, and I work with Raymond James advisors all across the West Coast. I currently live in San Diego, so local to you guys. Purpose of today's call, we have Nick Lacey on the line. He is our Chief Portfolio Strategist. He is a member of our investment committee, and he is going to provide a broad economic update and talk about some of the areas of the market that we feel comfortable owning today. So with that said, Nick, I'll turn it over to you to kind of introduce yourself, explain your role, and then I will start off firing some questions, if that sounds good to you.
No, it does, and I appreciate the time, and I'll try to make this worth everyone's time listening in. A couple of things that I would bring up. I'm gonna cover a handful of economic data points that I think are very important. And then I'll give a little bit of an update on what we see in the marketplace when it comes to opportunities, as well as threats. And then I'll talk a little bit about what's likely to happen. What are some of the things that are coming up that are important to pay attention to? And hopefully I'll do this in a short period of time. But before I do that, it's probably worth mentioning what I actually do for Raymond James. So my main job is overseeing asset allocation, which means we need to figure out where the opportunities around the world are, where the threats are, and how should advisors be working with their clients on positioning based on what we see happening. And I'll cover some of those. So first thing that I'm going to talk about is the economy. I got a handful of slides to go through, and if you wouldn't mind flashing up some of these slides. I don't have a lot of slides, but it wouldn't be a Zoom or a video conference without us talking about COVID, because it is now an everyday part of what we do. And what we see happening in the US is what we've seen happening around the world, where we've seen a spike in new cases. Fortunately, we haven't seen the increase in the death toll, which is great. But the increase in the cases is certainly problematic, and it's causing a bit of stress in the system, and it has some implications on the economy, and I'll talk about that. One of the things that we've seen, because the cases have been on the rise, we've also seen vaccinations start to increase. For a while, vaccinations started to stall, but we've now seen vaccinations start to pick up again, where you're averaging daily vaccination rates the same level that we saw a couple of months ago. So they're starting to go back up again. About 60% of the population has now been vaccinated with 2 doses. And, I think as time progresses, hopefully we'll get back to life as normal, and we just got to figure out what normal actually means. Because as I tell my kids every day, our normal is not normal from 2 years ago. Our normal is something different, and we have to adjust to that. So without further ado, I'm gonna hit 3 things that I think are important when it comes to the economy, because it all starts with the economy. And there are thousands and thousands of data points, but I'll give you the 3 that I think are very important. The first is it's about jobs. It's about jobs. And what the market cares about is whether or not the job situation is getting better or getting worse. That's what the market cares about. It doesn't care about the level. It wants to know, are things getting better or are things getting worse? And believe it or not, the simplest way to look at are things getting better or worse is simply look at the change in unemployment. If unemployment rates are coming down, the market likes that, because that means more people are going to work, which means there's more contribution to economic activity. It comes out every month, and there are a couple of important things to note here. First of all, at the heat of the pandemic, we hit almost 15% unemployment, which is the highest that we've seen since World War II. So major elevation in unemployment. However, since then, for the most part, every month it's gotten better. Now, it's still not where it was pre-pandemic, but we're down to about 5.4%, and we're going to continue to improve, although it's probably going to be at a slower pace, because 5.4 is pretty low. The question might be, where's the unemployment rate going? Because this is being forward-looking. The Federal Reserve has come out and said, because they have a dual mandate, right? Full employment and stable prices. That's their dual mandate. Well, full employment means something different to the Fed than it does to other people. So what does the Fed think full employment was? They believe the natural level of unemployment in the US is around 4%. Now, that is new. 5 years ago, they would have said normal inflation is 5%. Wait, get my camera right, 5%. But they've come down and said, we think because of the great mobility of labor and the ability of individuals to work remotely, that they don't think you have as big of a gap in the unemployment level from job to job as you used to have. They plan on keeping rates low until we reach 4% unemployment. So we're at 5.4 now. So don't expect the Fed to be acting very quickly. And we'll talk about what might make them act faster. Now, that data point comes out every month. If you want to find something more real time, you can look at weekly initial jobless claims, which is on the right. That basically tells you how many people are filing for unemployment insurance this last week. And in a normal week, and once again, what is normal? 2 years ago, you were averaging about 200,000 per week. You're now down to about 350,000. Which is good, but at one point in time, you were averaging in the thousands. So it's better. It's not where it needs to be. And on top of all that, those filing for continued claims are still about twice as high as long-term normal looks like. So still some room to go. Expect the Fed to stay accommodative until those employment numbers get to where they want them. The second thing that we watch, so jobs, important. The second is, where are we in the economic cycle? Now, the economic cycle is essentially, are things expanding or are things contracting? And are things expanding at an expanding rate, or are they expanding at a contracting rate? Something worth watching. Now, the economy is a big thing, and it's hard to know what's going on. As a matter of fact, we don't actually know what happened until 90 days after it happened, because we get all these revisions, because the US economy is big. It's the biggest in the world. So you have to rely, or at least we rely, on some metrics that give us an idea of where it's heading. The first one is something called the leading economic indicators. And the leading economic indicators is based on a basket of high frequency data that gives you an idea if the economy is expanding or contracting. And that's that light blue line on the left. Now, if you look at the 6-month average, this tells you which direction it's likely to head in. The most recent reading from the leading economic indicators is the highest ever. That basically tells you that the economy is likely to continue to expand at an above average rate for the next year. And if you look at that 6-month smooth, you can see that it's picking back up again. So we're likely to see economic growth over the next 12 months to be higher than average. And what is average? It's about 2%. That's the expected growth in the US long term. So expect the economy to grow at above 2% for the next year, substantially above 2%. Now, a secondary thing that you can look at is something called the ISM or the PMI reports, which come out every month. Those are surveys, so they're a little bit softer because they're not based on hard data. They're based on thousands and thousands of questions being asked about how do people feel about their business. And we're at or near the highest levels ever in some of those reports. So based on the hard data and based on some of the soft data, the economy is likely to improve at an improving rate, which is good. For investors in general, it's good for people looking for jobs. It should move things in the right direction. Now, how does this second part influence the markets? Well, simply look at company growth or earnings growth expectations. Growth in earnings and sales are expected to be some of the highest we've ever seen, simply because the economy is growing at such a fast pace and we're coming from a very low bottom. Because of that, the markets are responding very well. And if earnings, and you can think about earnings for 2021 for the US markets to be around 40% year over year. Now, somebody might scratch their head and say, 40%, what does that mean? Well, on average, it's 9. So 9% earnings growth is really good. We're looking at 40% this year. And as long as earnings are going up faster than prices, means markets are actually getting cheaper because you have earnings accelerating at a much faster pace than prices are. Last year was the opposite. Last year, prices went up and earnings went down, which made the markets appear more expensive. This year, the opposite is happening, where earnings are going up a lot, but yet prices, while they're not coming down, they're going up, but not nearly as much. So this is positive for investors, and it makes the market a little bit more stable than it was a year ago. So I mentioned 2 economic data points. I got to mention the third, which is what could derail economic growth. And we're all talking about it. We're all talking about inflation, because there's the inflation we see and then there's the inflation we expect to see. I've got 2 charts up here, and inflation is important because it will help dictate what the Federal Reserve is able to do. And let's walk through this. I'm going to start with the chart on the right. The chart on the right is the level of core inflation from the CPI and the PCE. The CPI is consumer-based, and it's really the most talked about. The PCE is the personal consumption expenditures. It's what the Federal Reserve really focuses on. The CPI is more the headline number that you hear about. PCE more Fed oriented. So I like to look at both. Historically, the Fed has come out and said, we would like to target 2% inflation. And if you look at the PCE line, we've really averaged about 1.5% since the financial crisis. So we haven't really seen 2% inflation consistently out of the personal consumption expenditures. The Fed recently changed their language, and they talked about fiat, which is not a car. It is flexible inflation average targeting. Now, what does all that jumble of words mean? It means they don't know what inflation is going to be, but it's going to average around 2%. And they said that because they want to produce inflation above 2% for a while, because they know eventually it's going to go back down below 2. They want to average 2%. So it's not a target, it's an average. Now, what has it been? Well, the personal consumption expenditures was 3.5%. That was pretty high compared to the 1.5%. But keep in mind, we're comparing this to prices a year ago, which prices were low. And when you hear Fed speak, right? Fed speak, which is inflation is transitory and it's a base effect. What they're really saying is we're comparing depressed prices a year ago to prices today. So you're going to get these prices that are going to spike, but they expect them to start coming back down. And as a matter of fact, looking at the CPI numbers, they were actually lower last month than the prior month. And you're likely to see inflation numbers continue to fall, although probably slowly, and we'll go through why. But most people that I talk to think inflation is going to be high in the future, and I ask them why, and we'll get into that. Why do you think inflation is going to be higher? What does the market think? Because the market's never really wrong. They're either a little bit early or a little bit late, depending on your perspective. On the left is the market's pricing mechanism for betting on inflation. I use the word betting, but it's really not betting. It's how much are investors demanding for inflation protected bonds. And if you take an inflation protected treasury bond, every year it grows its interest by the amount of inflation. And it's a good proxy for what the market is forecasting inflation for the next 5 or 10 years. And as of the most recent print, they're expecting inflation between 2.3 and 2.5% over the next 5 years, which is reasonable. That seems reasonable. We pumped a bunch of money into the system. We got supply chain issues. We've also got some strange numbers in the system, like airfare and rental cars and used car prices, where it's a small contribution to inflation, but it's a big enough number that it's moving the needle. So the market's saying we expect around, call it 2.5% inflation over the next 5 years, maybe 2.3%, somewhere between that range. And I think the Fed would be happy if we got there. What we're not likely to see is 4 to 5% inflation. And we're not likely to see 4 to 5% inflation because we basically export inflation, because we push money to where we can get the cheapest stuff. And that tends to be what we import. So we export our inflation because we buy imports using dollars. And as long as the dollar remains relatively strong, you're going to have cheaper imports, and that inflation gets exported to other countries. And we can go into more depth on that. So why does everybody think we're going to see a lot of inflation? Here's the stuff that I hear all the time. And I'm not saying it's wrong, and I'm not saying it's right. It's simply what people talk about. We've had a record growth in our money supply. Yes. Yeah, we've issued a lot of debt. We've done a lot of stuff through the Fed. We got a lot of money in circulation, although something like $8 trillion of that is in the Fed balance sheet. So it's not really in circulation. But there's the 70s, I'll call it the 70s mentality, which is, hey, if there's a lot of money in circulation, we're likely to see inflation. I get it. Doesn't mean it's going to happen. It just means it could. Well, what's the second thing that you hear people talking about? Have you seen the level of debt the government has? Like, well, yes, I see it all the time. It's in the news. The U.S. has over 125% debt to GDP. So what? That doesn't equal inflation. And as a matter of fact, Japan has something closer to 150% debt to GDP. And they have very little inflation. So high levels of debt does not equal inflation. Think about it this way. Is the risk the debt, or is the risk how much interest you're paying on that debt? And the U.S. is paying less than 2.5% interest on its debt. I mean, think about that. Less than 2.5% interest. Some of the lowest levels we've ever seen. And if you're looking at a company as an analyst and you want to know how risky is this company, do you care how much debt they have, or do you care how much it costs them to service that debt? And as an analyst, we look at the cost of servicing that debt because that's really your risk. So the government debt, it's an issue because you got to pay it back, but you're going to pay it back in cheaper dollars. It will only be a problem if and only if we start to see the dollar fall. And all of a sudden, all of our import prices start to rise. And then we're going to run into an issue. We're going to run into an issue because that inflation we're exporting, we might not be able to export it. So it's worth watching. But what other currency are people going to buy? Well, they're certainly not going to buy the pound. No offense, Jake. I know you're a UK guy, but you know the pound is an island nation, and it's only growing at a very small amount. They're not going to buy the yen. You know, the Japanese population is shrinking 0.4% a year. And who knows if the euro is going to be around in 5 years. And I don't think anybody trusts the yuan. I don't know anybody trusts the yuan. So the dollar is the reserve currency of the world. And until that stops being the case, not really an issue. But, you know, once again, we got to monitor it. And the last thing is, I hear people say, oh, U.S. savings rates are so high. As soon as they start putting that money to work, we're going to see inflation. Maybe, maybe not. I don't know. You know, I just, this is kind of like the mosaic theory where people grab all these little things and say, this must equal inflation. And I don't know. What I will say, we're confident we're likely to see higher inflation in the next 10 years than we saw in the last 10 years. Where we differ is we think inflation is probably going to be more like 2.3 to 2.5%, whereas historically it's been closer to 1.5 over the last 10 years. So you're likely to see 70 basis points more, 80, maybe even 100 basis points more. But as long as you can grow your economy above that, you really don't have an issue. You do have an implication on the bond market, though, and I'm going to talk about bonds, and then I'm going to stop and see if Jake's going to pummel me with questions here. Bond yields have been coming down. Treasury yields have been coming down, and then they started to go back up. The 10-year Treasury actually started to see its yields rise around September of last year, and they rose all the way through about mid-March, and then they stopped. We got to about 1.75% on the 10-year Treasury, and then it started coming back down again. Why? Well, it kind of parallels with COVID Delta variant coming out. The expectation that, well, maybe inflation's not going to be as bad as people think, and maybe future growth isn't going to be as high as the market thinks, and you know, maybe the Fed isn't going to raise interest rates as fast as we think. So, you know, we've started seeing Treasury yields come back down again. Why did municipal bond yields not go up? Because there's a lot of demand for muni bonds. Why? Taxes are probably going up. You know, that's the consequence of what we did during COVID, is you're probably going to see higher taxes, which makes muni bonds more attractive. And this is my last bond chart. I promise that I'm going to turn to Jake for questions. The two things that I watch the bond market is how much yield are corporate bonds willing to pay you above a Treasury. We call that spread. And what I'm showing on the left here is the high yield spread, high yield being a junk bond. And right now, high yield bonds are paying the least relative to a Treasury that they've ever paid, which means you're taking a lot of risk for a little bitty return. So be wary, buyer beware. And then I watch the slope of the U.S. yield curve. The slope is simply the difference between the 10-year bond and the 2-year bond. And it gives you an indication of future growth potential in the economy. And you can see for a while, the slope got steeper, which is good. You want a steeper slope because, well, longer bonds should pay more than shorter bonds. But since mid-March, we've seen the slope start to come back down again. It's worth watching. The market is trying to tell us something that we have to pay attention to. So I'm going to pause there, Jake, because that was a lot of stuff, and I can do this for an hour, but I'm not going to.
Yeah, before I ask any questions, Nick, I just want to check in with Katie to see if she's had any come through. No?
I don't see any questions live at this time.
Okay, sounds good. Thanks, Katie. So, Nick, I really like your comment earlier about it doesn't necessarily matter about the level of debt. It's more about, can you service that debt? So I guess my question is on that. Well, surely they're kind of handcuffed as to, you know, how much can they raise interest rates, right? Because if you start pushing interest rates to 3.5%, 4%, then that debt servicing is going to become an issue. Do you have a rough kind of speed limit on what you think interest rates can go up to at this point?
Yeah, I think people are going to be disappointed when they see how low interest rates are going to move. First of all, we don't think the Fed does anything on rates until the second half of 2023. So we probably have 2 years until the Fed moves the rates higher. But how much can they move it to? We're thinking they're going to move short rates up to 2%, and you get a 10-year bond at around 2.5 to 2.75%. You can't really have Treasury bond yields much higher than that. And when you look at our debt structure, we can afford to pay maybe 3.5%, maybe 4% on debt. But anything more than 3.5 to 4%, it means that our debt service ends up overtaking our economy. We'll go bankrupt because you can't grow your economy. As long as you can grow your economy nominal, so with inflation, as long as you can grow your economy at a faster rate than your debt, then you're going to be okay, all else being equal, and all else is never equal. But that kind of gives you an idea long term. I would not expect bond yields to get above 3%. And if so, I wouldn't expect them to get much above 3%. We peaked in 2018 at 3.25% on the 10-year. I would be surprised if we saw that in the next 10 years.
Another question I got for you, Nick, is when you look at a lot of the economic data that was coming out post-COVID, it was looking pretty ugly on paper, right? But since then, the stock market's done exceptionally well, right? We continue to hit all-time highs. So my question is, do you feel like the economy and the stock market is disconnected in some way?
You know, it's an interesting question, because that is definitely something that I get asked about the market is, hey, the market keeps going up, yet there's problems in the economy. And the stock market, especially the stock market, is a forward voting machine. And it's looking at the future and saying, what do we see happening? And last year, so 2020, we saw earnings in the US come down by 11%, which normally, if earnings are down by 11%, the prices are going to be down. But what the markets basically did is they said, look, we see all of these positive things happening. We think earnings are going to be up a lot, not in 2020, but 2021, the first half of 2021. So prices started to accelerate. Prices got ahead of earnings. So this year, right, this year prices are up, what, 15%? But yet earnings are up 42%. So it's the numerator and the denominator, right? Last year, the numerator went up a lot and the denominator went down. So it's a math function. You ended up with a market that was kind of expensive. This year, prices are going up a little bit, but earnings are going up a lot. So the market's actually cheaper. We have to be careful when we hear things like all-time high, because when the Dow hit 1,000, that was an all-time high. It doesn't mean anything. What we want to pay attention to, are we at all-time high valuations? And if that's the case, we want to take a step back and say, should we be concerned? And we're nowhere near all-time highs. And that's what's not getting talked about. All-time highs goes back to the first quarter of 2000. The markets were at all-time highs in valuation terms. Now they're not. I mean, they're 80, 85% of all-time high. But as long as you continue to see improvements in the fundamentals, and why are earnings growing so fast? It's because sales are growing fast, because companies figure this stuff out. And then companies take sales and they produce earnings. And what are companies doing today, or have been doing for the last year? They're issuing debt. Companies have issued a lot of debt, and they've paid off debt that they have outstanding at high interest rates. So it's like refinancing your house. Companies are doing the same thing. They're taking their 5% debt, they're buying it back and issuing 2.5% debt. And because of that, they have a lot more free cash flow that they can use to grow their business. And these are things that we talk about profitability. That's what it is. It's made the US markets some of the most profitable in the world. We've got more debt, but our sensitivity to that debt has come down so much because the interest rates have come down. That's another reason why I don't think the Fed's going to be in a hurry to raise rates. First of all, they want the whole refi business to keep going, because that's a big boom for the economy and puts a lot of people to work. Second, companies are going to run into problems if the Fed tries to raise rates too much. Remember the last time the Fed raised rates, it was December of 2018. And do you remember what Jay Powell did after that? He came out around Christmas and said, sorry about that. We're not going to do that again. So I think they're going to be very, very cautious in raising rates. You know, I think they're going to wait and exhaust every single possibility before they raise rates. You know, reducing purchases, which they'll probably do in a few months, that they're going to call tapering, which they did before, and the markets just didn't care. So there are a lot of other things they're going to do before they start raising interest rates. That's why we don't think it's going to be for another potentially 2 years from now.
Okay, and I have one last question, and I'll check in with Charles to see if he has any questions. When you look at a typical, evolution of a market cycle, Nick, I know it's very, very difficult to say how long it's going to be, but typically, cyclical areas of the market like industrials, financials, and energy do well when we're in an economic expansion. And then when you get towards the end of the expansion, areas of the market like utilities and staples do very well. I guess since we've seen such a rapid increase in sort of economic improvement, how do you see where we're at in the economic cycle right now, and does this differ relative to other economic cycles in the past?
I got to tell you, it's hard because, investors often talk about the market as being growth versus value, but the reality is it's more cyclicals versus defensives. That's really how the market bifurcates itself. Cyclicals being those exact industries and sectors that are tied to economic activity. Think about industrials, materials, energy. When you expect the economy to grow by an accelerating rate, those are the parts of the markets that typically do well. Those are your cyclicals. However, if you're thinking the economy is not going to grow at a fast rate, or maybe even shrink, you want defensive. Those are the companies whose top line growth continues to be strong regardless of what the economy is doing. And those tend to be your staples, but they also tend to be a lot of your communication services and your technology companies, where the reason for doing business has very little to do with economic activity. And we saw 2020 all the way through about October, defensives were winning. Defensives were winning. But starting in October, you saw a cyclical recovery. And it wasn't just sectors like energy and materials and industrials. It was also things like small caps and dividend paying stocks, those things that had kind of been left behind. For 6 months, those things dominated the marketplace. Now they've started to trail off a little bit around April. We started seeing defensives take back off again. The normal cycle might last 7 years on average, but on average means a lot of different things to a lot of different people. And this cycle has proven to be 4 times faster than the average cycle. So I don't know what that means. I can tell you what's supposed to happen, but I can guarantee you that's not going to happen. Something else is going to happen, and you kind of have to adapt to those things. And that's what we're doing. Is it's a similar playbook, but it's kind of on fast forward. So you got to be very careful.
Wow. I have one more question, Nick, before we start wrapping up. But I think one of the questions that everyday people want to hear is about supply shortages, right? The chip makers are having supply shortages, and it's going across a different variety of sectors. But it's affecting everybody's lives, right? Like cars, for example. So where do you see that going over the next year, or how long do you think we're going to have shortages in those sectors?
Yeah, I'll tell you what, it's something that's not going to go away anytime soon, because we're seeing a lot of factories in Asia get shut down again because of the Delta variant spreading there. We got a note from one of our equity analysts that covers semiconductors and basically warned that these things are getting slowed down again. I would have normally told you by the fourth quarter we should have been back up to normal production, but it could be Q1 of next year before we start to see production. And then you have this huge backlog. So you're going to see inventories today are really low. So you're going to see a huge buildup in inventories as everything starts to catch up. And I can tell you just personally, buying a graphics card for my son's computer, because he does a lot of whatever he does, doesn't matter. These things are on 6-month back order. You can't get them. And if you get them, you're probably getting the ones that nobody wants, which is why you're able to get it. Which is why used car prices were up 45%, because you don't have the chips to make new cars. In economics, we talk about short run versus long run. In the short run, there's nothing we can do about it. But in the long run, we're going to bring new plants onto production. But that stuff takes years. I think we're going to have supply chain issues at least the next 6 months, if not longer. And if you constantly have these shutdowns that are taking place, it's going to be damaging. And that's what could lead to inflation being spiky, because part of the inflation is, if you want it, you got to bid the price up because there's only so many to go around. That is true supply and demand in the short run. In the short run, when demand exceeds supply, you have higher prices. But in the long run, you have a new equilibrium. But it's going to take us a while to get there. And I don't care who pounds their chest and said we're going to build some new semiconductor facilities. Those things take years to get up and running.
Wow. Well, thank you. Katie, do you have any questions? Or are we all good?
I don't think so. I feel like it was a just a remarkable presentation. And when you said earlier that you could go on for hours, I think we could listen to it for hours because it really has been such a roller coaster. I think really what folks are hoping for is some stability, and to find out at the end of the day that we'll be in a great place when that stability occurs. Because I mean, I don't think we're quite too stable yet. But you know, everything that you talked about points to what I'm hearing in the business community, which is people are for the most part doing well. They have received, you know, grants or funding or support to kind of carry them through times when maybe we were closed, or they weren't able to be open, you know, or just for to go, whatever it might be for restaurants. And now that things have reopened, at least in our area, being a touristy area also, people seem to be doing pretty well and are pretty happy with where we've ended up, because I think the expectation was also very scary, you know, a year ago. So I appreciate all of the information and comments. We'd love to have you all back to share more as things maybe do become a little bit more stable.
Always.
Great. Well, thank you for having us. You know, I appreciate you giving us the opportunity. I want to, you know, I'm happy to introduce Jake and Nick because, you know, at Raymond James we have, you know, such a vast amount of resources. So I wanted you guys to get a sneak peek of the amount of work that goes behind, you know, managing the portfolios for clients. So Jake, Nick, thank you so much for today. Appreciate you guys being here.
Thanks, Jonathan. Appreciate all of you being here. Thank you so much.
Thank you.
Thanks, Charles. We'll look forward to seeing you soon.
Thank you,
okay?
Katie.
Absolutely. And thank you for tuning in to Live with Your Chamber. It's been great to bring you information from our local community, as you know, whether those are health updates, economic updates, or just what's happening with our local businesses and nonprofit organizations as well. We appreciate you supporting this series, and thanks to NBC Palm Springs also for sharing as well. If there's a way that I can help support you or your business, please don't hesitate to reach out. That's what your Chamber of Commerce is here for. Take care of yourselves and each other. We'll see you guys soon.